This video will be focusing on accounting for receivables, but more specifically, this video will be explaining how to estimate bad debts under the allowance method. But what does accounts receivable mean? An accounts receivable is defined as an amount owed by a customer who has purchased the company's product or service and are sometimes referred to as debtors or trade receivables. If the value of uncollectible receivables is regarded as material, which means the information will significantly affect the decisions of different users, the allowance method is preferred, which results in better matching. There are two types of approaches under the allowance method. The first one is the percentage of sales, and the second one is percentage of receivables. The percentage of sales approach is achieved by multiplying a company's credit sales generated during the accounting period to a percentage set by a business. For example, if a business made 1,400,000 credit sales in a year and estimates bad debt to be 0.5% of credit sales, it would add $7,000 to the allowance for doubtful debt account. The $7,000 is then recorded in a journal entry where bad debt expense is debited and allowance for doubtful debts is credited, as shown in the picture. The advantages of this is its simplicity, as it only requires one step. The disadvantage is that there is no consideration given to the resulting balance in the allowance for doubtful debts account for the prior period. Percentage of receivables approach refers to multiplying a percentage of estimated uncollectible amounts by the business's accounts receivable for that period. This approach requires two steps and takes into consideration the balance in the allowance for doubtful debt account. The first step, as seen on the left, is achieved by multiplying the gross accounts receivables by the business's set percentage. In this case, it is $50,000 times 5%. The second step, on the right, requires a T account, where the bad debt expense can be calculated in the picture shown. The value will differ if the prior amount was a debit or credit balance. Like the percentage of sales approach, the amount is recorded in a journal entry with bad debt expense debited and the allowance for doubtful debts credited. This approach is better at estimating the true net realizable value for accounts receivable. However, the percentage of receivables approach is usually considered to be somewhat less precise in meeting the requirements of the matching principle. Various factors such as business size, past performance, or the industry the business operates in will affect which method a business uses. I hope you enjoyed this video.